All right, so we're going to walk through a couple what we're calling case studies. And again, given the sort of short amount of time we have, we're not going to be pulling up spreadsheets and all that kind of thing. But we took a couple examples of projects that recently worked on, and just sort of thought it'd be helpful to kind of talk through some of the the sort of the project, what we were doing on it, what we were being asked to do, and some of the key issues that we had to wrestle with regards to the project. And like I said, we don't really have time to get into the details of how we did all the analysis, but I think just kind of talking through it at a high level will hopefully be helpful to the audience. So in this particular case, we'll talk about the surgery center project first. We were engaged to value a controlling interest in a multi-specialty surgery center by a national management company. So there's companies that are in the business of owning and operating surgery centers, and so they were acquiring a controlling interest in a multi-specialty one, and they had reached out wanting a fair market value opinion to help manage from a regulatory compliance perspective, and also to assist with evaluating the transaction, to basically to ensure that they weren't overpaying for the surgery center. So sort of high level, we're doing a value and a controlling, 55% controlling interest, so no discounts were applicable. This particular state, no CON was required for surgery centers in this particular state, so that's not something we had to evaluate. The center was in network with all major commercial payers, so we didn't have to deal with an out-of-network scenario, trying to model that to in-network, what an in-network would look like. And the surgery center was structured as a limited liability company. It was a pass-through entity. And I know that's a little controversial in some respects. We'll talk about that in a few minutes. With multi-specialty, they're performing cases in 8 different surgical specialties, approximately $5.2 million of net revenue and $1.6 million of EBITDA on both of those on a trailing 12-month basis. There were 16 physicians, and all anticipated to continue performing cases as normal post-transaction. The surgery center had been open a while. It's been open since 2006, so it's pretty mature and stable. Not a lot of substantial growth or anything historically. There were 2 operating rooms and 1 procedure room, and they were performing approximately 3,300 cases per year. That's a little bit of background information. So just sort of some of the things, high level, that we encountered, that might be good to know. Cash is always good, but cash something that you have to scrutinize fairly closely because depending upon the owner's preference, particularly if there's physicians involved, they may let cash build up for a period of time and just make distributions once a year. So we typically analyze cash pretty closely and determine how much is really needed for operations versus if there's any excess, and oftentimes there is excess. I'll maybe touch on this a little bit later, but in connection with projecting out working capital, we typically do that excluding cash, just to kind of eliminate that issue. With regards to accounts receivable, we evaluated that based on an aging report, and I think we wound up making some adjustments to accounts receivable based on our analysis of the aging report. How we typically do that, I don't not to get too far in the details, but with regards to, we distinguish between sort of the current the current accounts receivable are like the 0 to 45 days. Most likely has not been adjusted to the commercial insurance contracts. In other words, so when they it's important. Let me make sure I get this point across. So it's important to understand when evaluating accounts receivable, in this case a surgery center or physician practice or whatever it is, to understand whether those amounts that you're reviewing are stated on a gross or net basis. It's common when you get an accounts receivable aging report particularly for a small healthcare provider, that it's going to be not adjusted to the net realizable value or net realizable amount of those accounts receivable. So, for example, if the surgery center in this particular case, they're in network, so that means they have contracts with commercial insurance companies that define what they're going to pay for those particular surgeries. So until that first claim is processed and paid, it's common that the accounts receivable will be stated at a gross amount as opposed to a net. And therefore, when they get the payment from Blue Cross or United or whoever it is, at that point, then they adjust the accounts receivable down to the net amount that would be due from the patient. So accounts receivable that are generally, I'll say, over 60 days, just to be safe, those are most likely all going to be adjusted for the payment related to the commercial insurance company. So then it's really more, so you evaluate those based on collectability on the patient if there's a balance due, for example, whereas some of the newer accounts receivable may not be payer mix adjusted yet. They might not be adjusted for the commercial insurance contract. So that's just an important distinction to understand. Inventory is typically not on the balance sheet, so it has to be estimated, and it can be dependent upon the case mix. If there's a lot of orthopedics or spine cases, for example, or pain cases, the supplies inventory can be fairly significant. So it's important to understand fixed assets. Most of all that stuff is pretty straightforward. But it's important, we scrutinize fixed assets pretty closely to understand if they've been reinvesting in their medical equipment or not, and to help evaluate what future capital expenditure needs are going to be. The income statement, I'll scoot through this fairly quickly as we talked about it some earlier, but we analyze revenues by type of case and by physician, so that's really important. So, for example, if you got a significant amount of case volume tied to a few physicians and they're either non-owners or they're getting near retirement, that's a big risk factor that has to be considered. And then the operating expenses are much more straightforward. Those are going to be projected, based on the projected revenue, either on some kind of fixed or variable basis. It's common to see related party transactions in a lot of these surgery centers, particularly related to management services and sometimes billing services. So if that's the case, it needs to be scrutinized closely. And it's not uncommon to find some non-recurring expenses. This particular one surgery center had incurred some unusual maintenance expense related to a water leak, so we had to adjust for that. Some other sort of key factors, approximately 90% of the cases were performed by owner physicians, so that's good from a risk standpoint. However, some of those physicians were getting close to their end of their career, so that's a risk that would need to be taken into account. EBITDA margins were pretty normal compared to benchmark data that we utilized, and the payer mix was favorable. So they had approximately 70% of their case mix was related to commercial insurance companies versus 59% related to the benchmark that we were using. Let's go to the next slide. We after doing the initial analysis, we projected out the case volume by surgical specialty and by physician. We'll normally, this is sort of, and there's ongoing discussions with the client. There's the site visit and all that kind of stuff. So it's a dialogue. It's not, we're not just doing this without actually talking to the client about it. But we'll sometimes take the first pass at the projections based on the information that we've gathered from the client, and then we'll get, they'll need to review it and tweak it. But anyway, this is sort of how we tee it up, is that by a type of surgical specialty and by physician, and then we also distinguish between owners and non-owners that I mentioned earlier. There was a question on this subject a few minutes ago about how to estimate growth rates for reimbursement. We try to research as best we can what Medicare's view is going to be with regards to future reimbursement rates for surgery centers and by specialty to the extent we can find that out. And that's the MedPAC report that I referenced earlier is one example of that. Let's skip this. It's pretty straightforward, as far as how we project out. I'm a little bit concerned with minimum time. So, in our view, there may be different viewpoints on this, folks on the call, but we generally, we almost always adjust our cash flows, even for pass-through entities, LLCs, to an after-tax basis. The reason that, there's a little bit unique about the healthcare industry is that, the hypothetical buyers and sellers, they could be individual physicians, they can be nonprofit health systems, they can be for-profit entities, and it's very common. So what we do is, and I think it's pretty consistent with what other folks that do a lot of work in valuation work within this industry, is we adjust the cash flows to an after-tax basis, and then so anyway, that's enough on that. We can probably spend an hour talking about that particular topic on. We estimated a discount rate, weighted average cost of capital, and we used the build-up method to estimate the cost of equity because we, as I mentioned earlier, really didn't have good guidelines, public companies to help evaluate the beta. So we just used a build-up method, and I think that's really mostly what we're doing now with regards to most of the smaller healthcare entities. As I mentioned, there's no CON, so there was no CON protection from competition, so that's a risk factor that was taken into account. Physicians nearing retirement, that's a risk factor, and then the uncertainty regarding future reimbursement rates. So that's some of the sort of key risk factors that we took into consideration with regards to the discount rate. And sort of sum it up, where we wound up is that, we did not use an asset approach. It didn't make sense relative to the positive cash flow that Surgery Center was generating. We used the income approach, primarily the discounted cash flow method, and we did not use the market approach. There was no publicly traded guideline companies, or not enough. There's only one, which is Surgery Partners, and we didn't feel comfortable using it as a reliable benchmark, so we wound up using an income approach, the discounted cash flow method. So I know that was very quickly to go through that. I wanted to scoot through it quickly. We talked a lot about some of these issues earlier on, and I wanted to save time for Katie's going to walk you through a physician compensation valuation case study now